I brought to the attention of the CFTC at the March 25th, 2010 hearing on manipulation of the precious metals market how paper gold or unallocated gold is used to manipulate the price of gold to lower levels. This was despite Chairman Gary Gensler almost not allowing me to speak. Let's take a look.
We got another question. This one's for Mr. Christensen. I assume he can follow along here. But both Mr. Organ and Mr. Epstein in the second panel raised the concerns that short positions exceed the physical supply. The second panel kind of argued that wasn't a concern. Are you concerned that the shorts will not be able to deliver if called upon?
No, I'm not at all concerned. For one thing, it's been persistently that way for decades. Another thing is that there are any number of mechanisms allowing for cash settlements and problems. And the third thing is, as many people who are actually knowledgeable about the silver market and the gold market have testified today, almost all of those short positions are in fact hedges. The short futures positions are hedges offsetting long positions in the OTC market. So I don't really see a concern there.
Mr. Organ, would you like to respond?
I do see a risk on this, and I think it's a risk that we have to be very, very careful of as countries like China and South Korea, Russia start demanding and taking physical delivery of their gold and moving it offshore to their shores and putting pressures on on the COMEX. And we will probably come to a point in time where we will have a failure to deliver.
No, who are you?
Okay.
I don't know. No, I said no.
Oh, you said no.
I don't know who is this?
I'm Adrian Douglas. I'm assisting Harvey.
All right, sir. Yes.
So this, my microphone on?
Yes.
I'd just like to make a comment about we're talking about the futures market, hedging the physical market. But if you look at the physical market, the LBMA, it trades 20 million ounces of gold per day on a net basis, which is $22 billion. That's $5.4 trillion a year. That's half the size of the U.S. economy. If you take the gross amount, it's about 1.5 times the U.S. economy. That is not trading 100% backed metal. It's a fractional reserve basis. So, you can tell that from the LBMA's website because they trade in unallocated accounts. And if you look at their definition of unallocated account, they say you're an unsecured creditor. Well, if it's unallocated, if you buy 100 tons of gold, even if you don't have the serial numbers, you should have 100 tons of gold. So how can you be an unsecured creditor? Well, it's because it's fractional reserve accounting. I mean, you can't trade that much gold. It doesn't exist in the world. So the people who are hedging these positions on LBMA are essentially, it's paper hedging paper. And Bart Chilton uses the expression, stop the ponzimonium. This is a Ponzi scheme. Because gold is a unique commodity, and people have mentioned this, that it's left in the vault, it's not consumed. That means that most people trust the bullion banks to hold their gold, and they trade it on a ledger entry. So one of the issues we've got to address here is the size of the LBMA and the OTC markets, which are supposedly backing these positions which are hedging, but it's paper backing paper.
I guess I get time. I don't have any other questions. Commissioner Dunn.
Thank you, Mr. Chairman. Mr. Christensen, I appreciate the difficulty of trying to do this by remote, but at the end of your testimony, you begin talking about bona fide hedge exemptions for commercial traders must be part of position limits, and not to grant hedge exemptions to swap dealers would be devastating to exchanges' liquidity and price discovery capacity, and got into who determines what is legitimate or not. Could you amplify on that a bit and what you see as the danger there?
I could definitely amplify on it. Amplifying on it a bit is a little bit more difficult because it's a very big subject. The first thing is precious metals, copper, other metals, energies, they're all traded internationally, and these are fungible commodities by and large. I mean, there's been a lot of strange things that have been misspoken about the relevant, the difference between the retail market and the wholesale market, and we don't have time to really go over those, I don't think. But the fact of the matter is, excuse me, I'm in a building that has motion sensitive lights, and it doesn't recognize what I do as human activity.
Those were your words, not anybody here.
Yeah. No, actually, they were my wife's. If you start putting position limits on bona fide hedgers, for example, bullion banks, and the previous fellow was talking about hedges of paper on paper, and that's exactly right. Precious metals are financial assets, and like currencies and T-bills and T-bonds, they trade in the multiples of 100 times the underlying physical. And when people buy and sell those, they are voting and they're giving an economic view of the world, or a view of the economic world.
I think you'll agree that that was an epic exchange, and that left Chairman Gary Gensler speechless. And the icing on the cake was that cartel apologist Jeffrey Christian actually agreed with me, and that the gold market is a paper Ponzi scheme, and that the backing may be as little as 1%. Okay, now let's get back to our statistical study, and let's look at the silver market. The gold price cannot be suppressed without simultaneously suppressing the silver price. The next slides will show that the silver price has indeed been suppressed, but will also show that this is breaking down in a large part due to the efforts of G.A.T.A, and in particular its contribution to the March 25th, 2010 hearing by the CFTC on manipulation of the precious metals markets. This slide is a cross plot of the silver price and the gold price between 2003 and 2011. What can be seen in the portions which are indicated by the parallel green lines is that there is a linear relationship between the gold price and the silver price in these periods, which is 2003 to 2008 and 2008 to 2010. During this period, if you had given me the gold price, I would be able to tell you what the silver price was. Clearly that cannot be the result of a free market. This is a manipulated market, and this is strong evidence that the market was algorithmically traded with the gold price. This algorithmic trading broke down in 2010, which can be seen from the red arrow and the yellow circle. This was largely due to G.A.T.A's contribution to the CFTC March 25th, 2010 meeting on manipulation of the precious metals markets, and the exposure of the evidence of Andrew Maguire that the silver markets are manipulated by a cartel of bullion banks. Once investors realized that the silver market had been suppressed, the demand increased and the price started to climb, and it broke its relationship with gold. It may not yet be freely traded, but it's certainly made inroads into moving in that direction. I think it's fair to say that G.A.T.A's contribution to the CFTC March 25th meeting was a watershed event. The reduced selling into the PM fix is perhaps an early sign of the weakening hand of the gold cartel in controlling the gold price. Silver is showing a breakdown of a multi-year suppressive trend and strong indications of shortage of physical metal. The efforts of G.A.T.A are undoubtedly responsible for us entering into the endgame of precious metal price suppression. Ladies and gentlemen, I thank you for your attention. I promise for the next G.A.T.A conference I will be here to present in person.